Guys, we're talking about 810 and 814, a little bit about earnings per share, how common stock is sort of presented on the balance sheet, a little bit about dividends, and a lot about preferred versus common dividends. Uh, Let me explain to you that Chapter 8 is kind of our last block of the balance sheet. Remember, we've gone through Chapter 5, which was current assets, and then Chapter 6 was non-current assets, and then Chapter 7 was both current and non-current liabilities. And what we're doing is just separating the balance sheet into four major sections, and now we've gotten to equities. So we've touched on equity a little bit when we differentiated between paid-in capital and retained earnings in Chapter 2. And now we're going to be talking more about equities here in this chapter. But if we'll look at 810, they ask us first, what is the amount of shares, the average price of those shares that were issued? Okay, so we're looking at our total common stock amount, and we are taking that and dividing it by a number. Remember, that number is 3 million. That is the number of shares issued, because distinctively they asked you, what's the average price of shares issued? Okay, so watch for this to change. Like, it could be average price of shares outstanding, or average price maybe of shares authorized. So I just want you to be careful with that. You might see that change with this problem, but in this particular case, with this example, it's going to be average price of shares issued. Now, we're using the issued amount over here of 3 million. Now, B takes this and it says, in A, you're assuming that the total amount of common stock has no par value, has no stated value. It's simply presented at its value. Whatever the shares were issued at, we add them up and stick them on the balance sheet, right? But in B, it says, look, these stocks have a stated value. Now, this could be the par value or the stated value. But whenever you have a stated value of stocks, now most companies, by the way, have some kind of stated value or some kind of a par value, because when they issue their stocks, they like the public to get an understanding that the stocks are worth something, right? They're worth at least $1, right? Or they're worth at least $5, right? So it's kind of like setting a minimum. But then you're hoping, of course, that those stocks will sell for a lot more than that, and so often they do, of course, if you're any size company at all. But here we'll see a presentation here of common stock when it's got a stated value of $1. Then we have 7,500,000 authorized. We have 3 million issued, and then 2,700,000 outstanding. But look, it's the amount issued here is listed times the stated value of $1. So it's 3 million. And then what we'll do is we'll just throw everything else into kind of an additional paid-in capital. And we do use that account a good bit for this. Whenever you'll see with the journal entries that you'll do. But we have these amounts. Understand, this is how the subset, if you will, of how it would be listed on the balance sheet. And then they'd have a total paid-in capital amount of both the issued stated value plus whatever's in additional paid-in capital. And you'll see that here. Okay. Now, if you take this difference between issued and outstanding, what is that? Why is it, if you've issued that many shares of stock, why is a lesser number of those shares outstanding? Okay, so know that companies very often, if they have a good cash flow situation, they want their shares to maybe out in the market get a little stronger in their pricing. So what they'll do is they'll buy back some of the shares that are on the market. And when we do that, guys, that's the same answer for D, which is it's called treasury stock. And the reason that C uses the outstanding amount instead of the issued amount to come up with total dividends that they're paying out to stockholders is because when you multiply the amount you're going to pay out to stockholders, you're not going to pay yourself as a company. So remember, you have 300,000 shares that you've bought back off the market, and they are then parked in what we call treasury, which means that understand that these are issued promissory financial instruments that have been authorized by the SEC and then issued. And so therefore, when you buy them back, we look at that as saying, hey, that's part of returning those financial instruments back to where their origination came from. Okay? And we list that, keep in mind, on the equity section of the balance sheet. So I want you to look in your text, guys, and hunt this down. How does treasury stock affect the total stockholders' equity? Does it decrease it, increase it? Does it stay the same? You need to look at that and hunt that down in the chapters. And I want you to get a firm understanding of what treasury stock is and what it does. And notice that when we pay total dividends, we don't use those shares that are in treasury because we don't want to pay ourselves cash dividends. Okay, so the difference is treasury stock, guys, and that's the difference between issued and outstanding. Now understand that the authorized is the SEC has authorized these. And so often companies will have these large amounts that they've authorized simply because there's a cost involved in getting all that authorization. But often you'll see that not a whole lot of them have been issued because the company doesn't want to sell too much of its parts, right, to the public. You know, it wants to hold a lot of its equity close, so it doesn't do that. You know, it might. But if it needs capital, those authorizations are already there to sell those stocks. But 814, guys, gets to preferred stock. So we need to take a close look at this. 814 now. Okay. We have to calculate some dividend amounts associated with preferred stock. Right? And Dietrich Inc. Did not pay dividends for a couple of years, even though they had outstanding shares of 600,000. So they have a $50 par value cumulative preferred stock is what this is. Now, when I say cumulative, that means that even if you didn't pay them these dividends, right, you still owe them the dividends from the previous years. So that's what cumulative means. The company has 900,000 shares of common stock. Okay, so what they're basically telling you is that they want to issue some stock now. Okay, they want to go ahead and issue some dividends. They want to pay some dividends. So the annual dividend per share amount for the preferred stock you'll see here is the dividend rate, right, of 7.5% times the $50, which gives them $3.75 per share. Okay. Now we have outstanding for all 3 years. We have 3,100 shares outstanding. So we're going to multiply that annual dividend per share amount times the 3 years times the 3,100 shares because those shares are cumulative. And then we get 34,000, okay? And then we're going to issue 40 cents to our common stockholders and they get 11,600. Now understand that it's spelled out when you buy stock that is preferred, then it's spelled out how much interest, right? No, how much of a percentage, excuse me, you are due per year. Whenever the company decides to pay dividends, you will then be paid those dividends. Okay, so it's spelled out in the preferred stock contract. And then if you add these two together, guys, you get total dividends then that are received, okay, in 814. And so what I want y'all to do is to understand, why would someone want to buy preferred stock, right, over common stock? And I want you to think about why a company would issue preferred dividends instead of just common dividends, right? Because it's like saying, this preferred stock may be, we can sell it for a higher rate, but we're going to have to guarantee something to these who invest in the company. And I will tell you that preferred stock usually gets sold by a company when it's in trouble. It's a way in which to entice some capital to come to your company. And so this is something that you want to look at, because there's a list of items in chapter 8 that kind of tells you the reasons for preferred stock and why it's issued typically. And so you want to read through that and have an understanding of it, because you're going to run into a lot of that whenever you get into those test questions on chapter 8.